coupon rate is 8. So you tell me, market rate greater than the coupon rate? No. First case, you tell me, if market is giving you less interest and then the,
Yes.
yes, Misha?
It's premium.
Well done. If market is giving you 6% and company is giving you 8%, it means company will issue the bond at premium. Well done. If market interest rate and company interest rates, coupon rate are the same, it means company will issue the bond at market price, and the market price is called par value. What about the third one? If market is giving you higher interest rate than the company, like 10% greater than 8%, it means people won't buy your bond, so company will sold or company will issue the bond at discount prices. Right, guys? So do you understand? Premium,
Yeah.
discount. Well done.
Sir, I have a question. For companies, is it better if the market rate goes down, if the interest rate goes down or up?
No, because
If they have already issued bonds.
that is basically the finance stuff, but I think I should better educate you here as well, because it still left some kind of curiosity. So how so companies have also some finance managers, right? Company is not like, company don't have like some kind of stupid people. They just, have a dream that, okay, let's issue the bond at 10% and that's it. No. So where this 10% coupon rate came from? So they calculate some kind of formulas that, okay, the future interest rate in the market gonna be, expected future rate gonna be in 5 years, 10%, 12%, 17%, 8%, 9%, whatsoever. So they make some kind of like simulations or some kind of like scenario plannings, and they find out that, okay, right now, right now, in year one, the interest rate is 5%. So, but company issue at 10%. How they calculated this coupon rate? So they base their scenarios according to the future expected interest rate in the market. So let me just name it as a market rate. So these are the people like who hold like degrees of CFAs, actuaries, right? Those who have the the strong financial skills. So they predict the future, that in the future the market rate going to be like this one. So what should be the coupon rate? Because we would be gathering $2 million, which is a huge amount, and we don't want that our investor demand the money back. If we issue the bond at very low rate, okay, maybe they buy it and at the end they say that the company tricked us and we want our money back. They sue us and we have to pay them back their principal amount. So they look at the future expected rate, and through some formulas they came up with the figure. So that if year one, even you see that in year one the market rate is 5%, but they are issuing at 10%. So even it looks that the company is in disadvantage because they are paying them higher interest rate than the market, right? But look at the future, because on every year they will pay 10%. Even in the market, it is 17%. Still, they are paying 10%. So basically, you can say that they average out, and they came up with a fixed amount, and they say that okay, we're gonna give you fixed amount of 10%. So whatever in the market, 5%, 10%, 12%, 17%, 8%, we will give you 10%, right? So don't see that whether, you know, plus there are other factors like risk involved with the company as well. Like I told you, there are different types of bond as well, secured, unsecured. If there is unsecured bond, then they have to increase their coupon rate. Why? Because it is risky investment. Higher the risk, higher the return. If the risk is higher, they have to pay higher coupon rate as well, right? So there are many other factors, right? So at this level, on basic accounting, because this is principles of accounting, just remember that when the market rate is increased, is greater than the coupon rate, the bond is selling at discount. If the market rate is less than the coupon rate, bond is selling at premium. The reason I gave you that the bond prices are determined by the market forces of demand and supply. So you just think about in terms of demand and supply. So Misha, any other question?
No. That
Okay.
answers it.
Okay. So these are very complicated concepts. So if I go into that one, so it is, I think right now, not necessary and not required by your course as well. So this is pure finance, because we are studying the accounting here. So our concern is how we are going to make transaction entries, and that's it. So we are not going into that, the investment decisions, the valuation decisions, that is the finance stuff. Okay, here we go. So we have now understand what do we mean by par value, face value, or what do we mean by discount, what do we mean by premium value. So let's talk about the treatment, accounting treatment of these bonds payable when issued at par. So suppose Southwest Airline has $50,000 of 9% bond payable. So automatically assume that suppose Southwest Airline has 50,000 bonds, 9%. So this 9% means it is coupon that matures in 5 years. So assume that Southwest issued these bonds at par on January 1st, 2014. They issued these bonds on January 1st, 2014 at par. At par means at that time market rate was also 9%. So how much they receive by issuing the bonds? They receive 50,000, right? So what would be the entry? They issued the bonds and received cash 50,000. Entry is simple, and you will be surprised that entry is very simple. Cash to bonds payable, right? Maybe you laugh that why you build so much, fear in our mind that okay, the market value goes up and the discount and all the stuff. So entry are the same because we are learning these with perspective of accounting, right? Here we go. So you receive the cash 50,000 and you have to pay them back after 5 years. So this is a long-term liability. We call this bonds payable. This is not the current liability. Okay, that's it. Now let's talk about the interest part. So here, okay. Suppose Southwest Airline has 50,000 of 9% bonds payable that mature in 5 years, and interest payments occur each January 1st and July 1st. What does it mean? It means this 9% would be paid semi-annually. It means the interest is going to be paid twice a year. So what should be the interest expense? 50,000 multiplied by 9% multiplied by 6 by 12. So January 1st they issued, and on July 1st it's the time of first interest payment. So what should be the entry? Cash decrease, expense increase. Expense increase means debit, cash decrease mean credit. Asset decrease, credit. Any question?
Why did we multiply by 6/12? So like by half of it's semi-annual. Wouldn't it be like by 2?
You can also be 1 by 2.
No, I don't get that. Why is it, because it's semi-annually, why is it,
Semi-annually means twice a year. In a year there are 12 months, right? Right? How much you use that money?
Right.
6 months. You use that money for 6 months, so you have to pay 9% for 6 months. And how many months are there? 12. So that's why you divide it by 6 by 12. If you want to do that for 2, it's okay, because concept is the same. 6, 2s are 12. You can also do that, 4.5. Understand that?
Semi-annually, that's twice a year?
Yeah, semi-annually or biannually means twice a year, 2 times a year.
Okay.
Okay, I am going to also explain this to you. Okay, if the payment is annually, the payment is semi-annually, or so annually means you use that 9% throughout the year, right? It means you use that 9% for 12 months. And how many months are in year 12? Answer would be 9%, right? So we normally don't multiply it with anyone because 12 by 12 is 1, right guys? Okay, semi-annually means or biannually means you pay twice a year. So payment 1 and payment 2. So you use your 9% for 6 months, and how many total months in a year? 12. Or you can just say that 9% multiplied by 1 by 2. Answer is the same, 4.5%. Quarterly means there are 4 quarters. It means you use that 9% for 4 months, and there are 12 months in a year. Answer would be like this. So secondly, also 9% multiplied by, you use the next quarter. Similarly with the fourth one as well, 9% multiplied by 4 by 12. For monthly, it would be 9% multiplied by 1 by, because you use for 1 month, divided by total months. Right, Misha? This is how we are going to treat our interest rate. Misha, understand?
Yes.
Okay. Let's go back to our slide. And now for the year end, the second payment of the interest rate. Suppose the Southwest airline has 50,000 of 9% bonds payable that mature in 5 years. At year end, the Southwest accrues interest expense and interest